Welcome everybody to the 41st annual Eide Bailly Bank Seminar. At this time, I would like to recognize our partners and associates of Eide Bailly who support this event. Thank you for all your service you provide to our firm and to our clients. And thank you all for attending this virtual event today. My name is Gary Smith, and I'm the partner in charge of our financial institution service group at Eide Bailly, and I'm excited to be your host today. Our motto for this year is community. And we recognize how community bankers have brought unity back to their communities across the United States. Whether it was with PPP loans or helping businesses and individuals survive and thrive by providing unwavering commitment to the communities you serve. We are excited to have you join us today. We would like to give back to you today with an afternoon of content today eligible for up to 2 hours of CPE. Today, the Eide Bailly Bank Seminar has turned from an in-person live event to a 100% virtual format throughout November. We appreciate your attendance today and hope that you join us for our virtual events on November 16th and 18th, in addition to today's seminar. You can visit eidebailly.com/bank seminar 2021 to register. Before we get to our keynote, I would like to extend a special thank you to Cheryl Knutson and Amy DeGeorge, who has spent a lot of time, considerable amount of time planning and organizing this event. Thank you, Cheryl, and thank you, Amy. I'm honored to introduce our keynote speaker to kick us off this afternoon at our Eide Bailly Bank Seminar, Juan Quaranta. Ron possesses almost 3 decades of experience in global financial services and technology industries. He currently serves as the chairman and the chief executive officer of the Wall Street Blockchain Alliance, the world's leading nonprofit trade association promoting the comprehensive adoption of blockchain technology and crypto assets across global financial markets. Prior to this, Ron served as the CEO of Derivatrust Technologies, a pioneer in software and technology firm for financial market participants. Ron is the editor and contributing author of the book, Blockchain and Financial Markets and Beyond, Challenges and Applications, published by Risk Books, as well as a contributor to Blockchain and Cryptocurrency Regulation 2019, published by Global Legal Insights. In addition, he has recently been named to the top 100 most influential people in accounting list by Accounting Today. He is a frequent guest of major media outlets, including Bloomberg Radio, and is a sought-after speaker and writer regarding financial technology and innovation. Ron also serves as an advisor to multiple startups and corporations focused on fintech innovation and blockchain technology. We will have time for questions at the end of Ron's presentation. Please utilize the Q&A function in the Zoom meeting, and Ron, over to you.
Gary, thank you so much. And I'm pretty sure next time we get together, I'll have to trim down that bio a little bit. You're going to kill me if I put a bio in front of you that long. Thank you all for being here. Gary and Cheryl and Amy and all of the team over at Eide Bailly, really appreciate the opportunity. And for the audience, really grateful to have this time with all of you. I wanted to talk about blockchain, crypto assets, and what I'm calling the evolution of banking. So a couple of objectives. I apologize, Amy. So a little bit about our mission, if I could, real quickly. My board would be very upset with me if I didn't mention this. So the Wall Street Blockchain Alliance is a not-for-profit trade association. I come out of financial markets and financial technology, but all of our members are across so many different industry segments, from financial services to banking to law and accounting. And our mission is really to guide and promote what we're calling comprehensive adoption of both blockchain technology and crypto assets across global markets. For today's presentation, I really do have several objectives I wanted to go through with all of you. Firstly, really want to talk about the definition and history of blockchain, its origins, its uses, and its benefits. I suspect many of you have heard versions of this in the past, potentially from me. I think it's always important to kind of lay down that foundation so that we understand where it's coming from, what it's meant to accomplish, and then ultimately, what does it mean strategically for the banking industry and for so many other industries around the world. I want to talk a little bit about blockchain in the global market case, the use cases and the trends. I've given this presentation so many times, and every time I give this presentation, there are new use cases. There are new implementations in global marketplaces. And while I won't go deep on any particular one, I do want to make our members and our colleagues and participants here aware of those use cases and to give you a picture of how pervasive blockchain is becoming in the global marketplace, how pervasive in many ways I believe crypto assets will be. The joke I've often put forward is you'll know blockchains arrived when we stop saying blockchain. It's just part of the technology that we use behind the scenes. No presentation about any of these topics really would be complete if I didn't mention crypto assets. I really want to talk about what they are, how many of them there are. I think you'll be stunned at some of the statistics and the data that I've researched and put together. The data evolves over time, and it really is becoming a pervasive, what I broadly call new asset class. For the purposes of this event, for this meeting, I want to talk about obviously blockchain and the banking industry. I've been in financial services a long time, and I remember the early days of having the conversation about crypto assets and blockchain with banking colleagues across the country. And when I first started this journey, it more often than not led me to being escorted out of the conference room. Today, so many of our banking colleagues, so many of our banking members are deeply involved in understanding what's the technology mean, what does it mean for the future of banking, and then ultimately even what do we mean when we talk about banking? I want to wrap that portion up with something we're calling, well, you may already know, CBDCs, central bank digital currencies, DeFi or decentralized finance, and then ultimately stablecoins. For those of you who are regulators in this space, I'll also touch on that regulatory landscape. Many of you are probably already involved in the analysis and conversation of what are CBDCs and DeFi and stablecoins, and what does it mean to be an economic entity, a financial entity in the world today? What do banking services mean, and what are the services that are being offered by some of the disruptors? I want to address that a little bit because I think it's important in creating the roadmap for the banking industry over time. And then finally, how to adapt. Some bullet points on what I believe it means for your business, what I believe it means for the banking industry, as well as so many other industries, and potential ways to structure how you address those going forward. So let's start with the basics, the blockchain definitions and origins. And for those of you who may be computer scientists out there or have a computer science background, so many of my computer science colleagues look at my definitions and tell me I'm missing the mark on the technicals. This isn't meant to be a deep technical dive. I want to give you the perspective on what it's used for. Blockchain is a public ledger at its core, and I'm certainly talking about the public blockchains. I'll talk a bit more about private in a moment. A distributed, secure database that records transactions. It's a transactional register, but it leverages cryptography and peer-to-peer technology to secure group data into blocks, and then really store that data set or those data sets in a mutable chain of transactions. And you'll see in a moment why that's important. Here's the core of what public blockchain is meant to accomplish, though. It's meant to accomplish these things without any trusted central authority. And that's a weird thing to say in the world we live in today. So many of us have grown up in a world for millennia practically, where there's always a central intermediary, someone standing in the breach between us and whomever we're doing business with. Technology has evolved and given us the ability to not need to do that. I think there are challenges there, but I think there are real significant benefits, everything from access to cybersecurity and more. And we'll address those a little bit later on also. Maintenance of a blockchain is performed by a network of nodes with information being uploaded to the blockchain that is validated and approved by those nodes, and prior to what we call final approval in addition to the blockchain. And all of those additions are broadcast to the network in real time. Well, what does that mean? Ultimately, it means that every node, every participant in that network is seeing the same thing at the same time. We've been in the industry long enough to remember the conversations around the golden copy or the golden record of data. Blockchain evolves what we mean by the golden record. Everyone's got a copy of the most updated data set. And really understanding that that data set is validated, that those transactions posted would not have been posted were they not able to be and accurate. There are challenges there. I'll address those a little bit later on as well, but understanding that everyone sees the same thing at the same time, that's a critical differentiator for global blockchains. And here's kind of a graphical representation, this kind of ledger nodes that are participating in a network, and each node operator updating and adding records based on consensus, which is how those nodes communicate with each other. I don't want to minimize the technological importance of that word consensus. It really is a way of allowing participants in this ecosystem to confirm transactions, to confirm information, to share data, and incent them to be part of that network. So when you look at this chart, one of the things that I would suggest also is, each of these ledgers is actually a node. I would consider the importance of understanding what do we mean by participants in our ecosystem? Who do we transact with? As bankers in the banking industry, who do we transact with? In securities trading, in global financial markets, in government and central bank work? Who are we communicating with? Who are we connecting with? In theory, each one of those connection points is a potential node on a blockchain system. And it's important for us to give that some thought as we visualize what the future will look like leveraging blockchain technology. I mentioned a couple of things that I thought were interesting, and I wanted to call them out here. Often in the blockchain conversation, we've heard people say, well, this is something totally unique and new, and in many ways it is. Those of you who know the Satoshi Nakamoto white paper, I've read it many, many times. There's still these ongoing conversations about who is Satoshi Nakamoto, the pseudonymous creator of the Bitcoin blockchain. I think who it is less important than how well it works. But it really is a combination of two different technologies. One is cryptography, which really allows for secure communication. Anyone who's, cryptography has been around for millennia. Anytime we've used secret codes and blind one-to-one communication, that's cryptography. And allowing for that secure communication in a way that provides data confidentiality, data integrity, authentication of transactions. Think about the concept of reconciliations going away. And then what we call non-repudiation. You can't undo a contract, or you can't undo a transaction in a blockchain world. And again, there are challenges there, but enormous, enormous benefits. And then also a combination of cryptography with peer-to-peer networking, this kind of network of interconnected nodes that share resources amongst each other. And we can have really complicated conversations around proof of work. Many of you might have heard in the news that proof of work blockchains are highly energy inefficient and really have a really poor carbon footprint. I can assure you there's so much work that's happening in the blockchain space to minimize that. But that interconnected network of nodes sharing resources, managing and maintaining the network because they're incented to do so. And again, operating without the use of a centralized administrative system. That scares a lot of colleagues in multiple industries. But I would offer up the possibility that it also minimizes risk. Centralized systems in the 21st century are prime targets for for cyber attacks and ransomware and the other challenges that we've seen in global markets. Our suggestion is that blockchain is a solution to those challenges. I often like to visualize when I have these conversations about blockchain and I talk about its definitions and its origins. One way to do that, and one way that we've actually shared with members and colleagues, is think about a blockchain, considering that file on computers containing blocks. Think about the blocks in a blockchain the way you'd think about the pages in a book. Every page in a book references the previous page. Every block in a blockchain references the previous block using a fingerprint. In a book, that fingerprint is the page number. Amy and I know that page 10 always comes after page 9, for example. And I've used this example many, many times. Every block in the blockchain, block 10 knows something about what's in the data of block 9, and on and on and on. And when you get to size and scale, and we can have offline technology conversations about how difficult it gets to hack or change a blockchain, particularly a public blockchain. And before I move forward, one of the arguments we've often had is, well, Ron, we keep hearing in the news about a hack of a blockchain or someone's stolen crypto funds. I want to really level set here. The Bitcoin blockchain has never been hacked. People who have wallets, who have accounts or access to blockchains, have lost their private keys, have lost their passwords. So again, the cybersecurity challenges of the world don't evaporate because of blockchain. They just evolved. But blockchains themselves, the largest ones, Bitcoin blockchain, Ethereum blockchain, have not been hacked or altered in significant ways. A bit later on, I'll talk about smart contracts that have been altered, and you'll see the reason for that. But again, Bitcoin blockchain, the big public blockchains, very secure data sets. And in the Bitcoin blockchain's case, over a decade old now. So what are those benefits? There are real benefits associated with blockchain technology. And this isn't an industry-specific conversation. This is across multiple industries, multiple layers of government, multiple layers, I would argue, of regulators. I know we have some regulators and colleagues in the audience. Later on, I'll talk a little bit about why blockchain is a tool for regulators. So when we look at some of these benefits, decentralized, not needing to trust a centralized authority. Again, weird to say, given the world we all come from, But that's where the world's evolving. People wanting the decentralized ability to control their transactions, to control their data. And decentralization, again, means that you have less of a target of centralized data sets. When credit reporting agencies and banks or giant firms like Yahoo are being hacked on a regular basis, the benefit of decentralization starts to become clear. Distributed, which is more reliable, where component failure is minimized. I've been on Wall Street for long enough to remember the days where someone pulled a plug in a centralized system and it took down trading for an entire day, and it was an accident that didn't mean to happen. That's a component failure, and a pretty critical one. A decentralized and distributed system minimizes those potential component failures over time. This idea of dispersed consensus, the equal distribution of consensus authority. It's one thing to talk about setting up the rules and having people engage with those ecosystems, but what about an entire ecosystem of participants, communities of commerce that equally manage who gets access, how it's transacted? And think about our business models when we talk about that. Who are banks' customers? Who are banks' partners? This dispersed consensus will play into the conversation about what I often say is, what does banking look like in the future? Immutable data that cannot be modified or tamper-proof. And again, a lot of challenges there, but a lot of benefit to data being secure in its validity and tamper-proof in its recording. And then finally, transparency, this kind of idea of a transaction history being more easily audited, being more accurate and consistent. One of the real benefits that we bring forward about that, public blockchains are fully transparent. Any of us on this call can look up any public blockchain. There are portals on the internet that let you check down to the original Genesis transaction of any public blockchain. But this transparency also allows for the ability to, what I broadly call, police or monitor these ecosystems. There are tools being created right now that allow regulators, that allow law enforcement officers, that allow bankers and stock exchanges to check transactions, immutably check transactions, and have a transparent understanding of how those trades happen. So think about that from a regulatory reporting perspective. Think about that from an auditing perspective as well. As you begin to percolate and understand the ideas of blockchain benefits, it really reinforces that blockchain is a tool in many regards for global markets. So I mentioned earlier private versus public blockchains. The purists in the blockchain crypto asset world will often tell me that, well, Ron, there shouldn't be private blockchains, which I kind of chuckle at, because that's not really the world we live in. We don't yet fully live in a fully decentralized, everyone is their own banker, everyone is their own money, everyone is their own broker, rather. We live in the real world, and the real world requires some level of engagement with the entities we know, banks and government and regulators and brokerage firms, et cetera. So private blockchains are an important part of this overall ecosystem. Private blockchains are not fully public decentralized networks. They're essentially creating a system where access permissions are controlled, where those kind of rights to, we talked about it a bit earlier, monitor data and validate data and modify or read blockchain is really restricted to a few users. This really maintains the partial guarantees of authenticity and those benefits of decentralization that I talked about a bit earlier in public blockchains, but really helping to embed blockchains in the world that we understand. Indeed, private blockchains are the primary focus, I wouldn't say of just financial institutions, but of many of the larger institutions that we know that are deeply involved in leveraging blockchain and blockchain innovation and technology. Kind of a follow-on to this is this idea of consortium blockchain, where this consensus process of controlled pre-selected nodes, a community that you select. Think about a grouping of financial institutions we've seen, including some banks, and including supply chain firms, including insurance firms, for example. When you begin to give thought to what that consortium looks like, in my mind, it helps to paint the picture of the future of our businesses, the future of different industries that will need to interoperate with each other, leveraging blockchain technology. So I mentioned blockchain use cases earlier. This is literally a small sample, and I certainly won't go into each of these, but things like anti-money laundering, tracking, and management. There are several providers in the space right now that are deeply involved in tracking cryptocurrency transactions. If you haven't heard the names of firms like Elliptic or Chainalysis or blockchain intelligence group, they have tools right now that are being used to track anti-money laundering violations, potential FBAR violations. Matter of fact, many of you might recall the Colonial Pipeline hack, which happened, I want to say it was a couple of months ago, and the ransomware demanded payment in Bitcoin, which the company did, and subsequently, much of that was returned. Blockchain tools we use to track those Bitcoin payments and really target those particular addresses. And again, a lot of those public addresses are anonymous, but I would offer up to the audience here, please keep in mind, anonymous does not mean invisible. There are powerful tools. As a matter of fact, I believe OFAC already has a list of blockchain addresses or crypto addresses that are blacklisted, essentially, that are tied to illicit activity. So there are the tool sets to protect how people and organizations engage in the cryptocurrency and blockchain world. Things like cross-border payments, currency exchanging, pardon me, loyalty and rewards programs, supply chain management. We keep hearing in the news about the challenges of the supply chain. Some of the biggest shippers right now and leveraging the biggest technology providers. I go back to the IBM work with Walmart and the kind of the IBM Food Trust that is meant to track food shipments in the supply chain, leveraging blockchain technology in a way that minimizes cost, maximizes efficiency, and reduces shipping time. Things like NFT marketplaces, we don't even have time here, but there's probably another event worthy of the time, non-fungible tokens. And many of you might have seen ridiculous digital art that gets sold for tens of millions of dollars as NFTs. NFTs represent something much broader. From the banking perspective, I would keep in mind that you will have customers in the future, I promise you, that will have some level of wealth or engagement in the NFT market. And right now, many of those non-fungible tokens are being used as collateral for loans. Things like real-time IoT operating systems, real estate processing transactions. So I give you this list and happy to share resources with all of you. So much is happening across so many different aspects of the world economy that in my mind, blockchain needs to be one of the core innovations focused on by both the banking industry as well as regulators around the world. So as I mentioned earlier, I couldn't do any presentation, and I'm sure Gary and Cheryl are sick and tired of hearing me talk about crypto assets, but without talking about the global crypto asset market. Crypto assets can no longer be ignored. I had the privilege of having this conversation and presenting at an Eide Bailly event. It was in 2018. I can't believe it's been that long. And at the time, the global market cap for all crypto assets was about $200 billion. And I remember banker colleagues and stock exchange colleagues telling me, that's it, Ron, it's totally a bubble and this is all going away. When I put this deck together, that market cap value was over $2.6 trillion. Volatile, yes, but climbing. And indeed, there were over 13,000 different crypto assets are available globally. That number was 2,100 when I originally gave this presentation. In my opinion, this is a new asset class. And that's a difficult thing to say because so many colleagues, particularly at regulators, particularly in government and legislators, are trying to understand, and we'll address this later, how to fit crypto assets into the regulatory schema that we have now. These are different creatures in my mind, crypto assets. So I consider them a new asset class, but that said, I think it's potentially time for our regulatory schemes and frameworks to kind of evolve to encompass what crypto assets and blockchain are meant to accomplish. Alongside this development has been the idea that major corporations are holding crypto in company treasury accounts. You've probably all heard about Tesla holding billions of dollars and MicroStrategy. I believe the CEO of MicroStrategy was on an event earlier this week, and they continue buying hundreds of millions of dollars of Bitcoin at a time because they have this long-term belief that Bitcoin and other crypto assets will be true units of accounts for how digital trade happens around the world. And what I could share with you, that's what you see in the news. A lot of the conversations that we have with our members really are about public and private companies understanding, how do we hold crypto in our treasuries? Do we need it there? How do we gain the benefit of having crypto in our treasury accounts? And I'm not an accountant by training, but for the accountants out there, you'll appreciate the challenges a lot of these companies have, which is they can only recognize downward adjustments of crypto asset value. I think Tesla was complaining about this, Elon Musk, some time ago, but not increased value of crypto assets. So there's even the evolution of the tax code in a world of crypto assets. Likewise, the payment rails, Visa, MasterCard, PayPal, all are beginning to look at accepting cryptocurrency, allowing crypto on their rails. I think MasterCard earlier this week, or potentially late last week, had announced that they are rapidly moving forward to allowing their clients to engage in crypto on the MasterCard rails. And they also purchased a crypto forensics firm, I believe it's a company called CipherTrace, that gives them the tools to do the tracking and the compliance that we were talking about. Large companies are beginning to prepare for the future we've been talking about here. Things like central bank digital currencies and DeFi and stablecoins, I'll define them a bit more, but they're really changing what we mean by banking, what we mean by finance. And I know that's often looked at critically when I say those things, but when we look at the disruptors in this space, from a fintech perspective, from even how to raise capital perspective, we really need to account for these innovations to understand, again, what's the strategic roadmap for us in the future? And then ultimately also blockchain integration into what I call regular banking processes, this idea of trust and custody. I'll talk a little bit later about some of the biggest custodians, and full disclosure, some of them are members of my organization, and we've worked with them in the past, already have trust and custody work and ecosystems set up to show how blockchain can integrate with their current workflows and how crypto could potentially be integrated in their current systems. Challenges there, agreed. Challenges around interoperability and integration, which are always challenges of new technology innovations, but that work is happening right now. I wanted to share with you, this is from earlier this year. Fidelity always does a wonderful survey. I think this was in January or February of this year. And this one was about the appeal of digital assets to institutional investors. And I think it's important to point out, the reason I'm putting this forward is that we're beginning to see the shift. The percentage of US and European investors, again, at the institutional level, who are finding digital assets appealing. And it's interesting when you break down the data here. For a long time, it was high potential upside in an almost zero yield, or depending on transitory inflation, negative yield world. Chasing high yield and chasing high APY makes sense. But it's also interesting to see how they're looking at it as an innovative tech play, how innovation is being built into the core of how companies are planning their futures and how companies are doing business. Even seeing one of these, the 22% for enabling decentralization, 5 years ago, we would not have seen that in a global institutional survey. And so again, for all our colleagues in this call, keep that in mind, because these are your customers at the institutional level, increasingly, and we'll talk a little bit about it later, at the retail level as well. So I've, as I mentioned earlier, and as Gary kindly mentioned earlier, I've been in financial markets for a long time, and I thought I'd dig into some data. There's a wonderful organization. We have no economic interest. It's called Into the Block. Any of you who are really interested in kind of parsing through data around the crypto world and global financial markets, they do a wonderful job. And I thought I'd put together a chart that talked a little bit about the data I had just mentioned and the results of that survey. When you look at things like year-to-date performance, S&P 500 up over 22%, the Dow just over 17, and this was from several days ago. It's probably changed by now. And when I look at these numbers and I talk to my colleagues, in any given normal year, these would be fantastic numbers. We would love to see the Dow up 17% year over year. And I remember a conversation with a colleague, a banker colleague, and a couple of colleagues that have moved into crypto hedge funds. There were a couple of hedge fund managing partners previously. And when I described this to them, they said, well, that's kind of cute, Ron. And I was kind of struck by that. And I asked why, and we worked on doing some research together. And then I came to realize why. And the reason for that is when you map these year-to-date performances against crypto assets as they are, and which assets are growing the most, Bitcoin is up 107% year-to-date. And Bitcoin is the most liquid and largest of the crypto assets out there. Not to be undone, number two, the Ethereum, the Ether that is available on the Ethereum network, a crypto asset, is up over 460% year-to-date. It is no surprise that institutional and retail clients are looking at these kind of performance numbers and saying, I need to be involved in these. And again, I offer this data up simply because it really does point to the industry trends, in my mind, the generational trends that we'll talk about a little bit later on. So the core of my conversation, what about blockchain and the banking industry? And I'm certain all of you in the banking side, all of you on the regulatory side, all of you involved in accounting and financial markets, we have to realize that the world of banking and financial markets, as with so many different industries, is evolving. And you're beginning to see this in some pretty public plays in this space. So many of you might have seen the news not too long ago. US Bank, the fifth biggest retail bank, has announced that their cryptocurrency custody service will be available to fund managers. Those fund managers have retail and institutional clients. This is beginning to percolate throughout the banking and financial market systems. Major players, Bank of New York Mellon, State Street, Northern Trust, many colleagues in large banks that are members and in mid-sized banks and community banks that are members of the WSBA as well have all announced plans to custody digital assets. And I would argue that that's fairly forward-looking. As a matter of fact, one of the thoughts I put forward is that my colleagues in the banking industry are some of the more forward-thinking that I've seen in the blockchain and crypto space. Some of the banks got involved early on, as some of the exchanges and stock brokerage firms did. Certainly much more advanced than some of the insurance providers and then some other, certainly in the healthcare industry. But it's interesting to see how this is beginning again to seep into the long-range plans of industry giants across the board. Further news, for example, Bank of America launched cryptocurrency research coverage, calling the market too large to ignore. I've been saying that since 2013, and they didn't want to listen. I guess they're starting to finally listen now. And again, acknowledging crypto's volatility, but saying that crypto's showing signs of maturity, not just because it's over a $2 trillion marketplace. And that's becoming more commonplace in investment portfolios. And this wonderful, wonderful quote that I use often now from the reporter from Bank of America and their press release, their view is that there could be more opportunity than the skeptics have expected. And I fully agree with that. At a personal level, my entire career is now in the blockchain and crypto asset space, and so many different industry groups are participating in that through us. Financial players are beginning to accept cryptocurrencies as what I broadly call a legitimate asset class. And I want to address that for a moment because for so long, I heard many people, prominent names in global markets as well, say that it's, you've probably just heard some of these quotes, it's rat poison, it's only for illicit transactions. There's no shortage of politicians who apparently believe it's only for tax evasion. When you look at the data around what portions of crypto are truly used for illicit transactions, and again, not minimizing that those are challenges, it's actually significantly smaller than a lot of the mainstream or regular native global market participants. So there's this kind of dichotomy between what the industry sees and what some certainly politicians are saying, but players are beginning to accept it, beginning to understand that this is part of the future of their business. And often when we have this conversation about blockchain in the banking industry, I think I've seen iterations of this kind of the end is near for money conversation for years. I suspect it was probably very similar to the conversations that probably popped up when the first credit cards popped up. But it's interesting to see some of the survey data that we're beginning to see. Deloitte did a wonderful job earlier this year. They did their global 2021 global blockchain survey, which I think is fully publicly available. 76% of surveyed banking executives said that digital assets will quote unquote rule in 10 years. I presume meaning that'll be a large portion of how transactions are engaged in global banking. Likewise, 76% of financial service industry respondents agreed that we won't use physical money in 10 years' time, that we'll be using blockchain and various forms of digital currency. And if you think that's a bit of hyperbole, sorry, Amy, that's the word I was looking for. If you did think that was hyperbole, you'd understand when we're talking about some of these changes that are happening overseas. China, for example, is literally, they're hosting the Olympics next year. You will only be able to engage in commerce at a street day-to-day retail level if you download China's CBDC digital wallet and engage in digital yuan transactions. So this is real and it's happening at an increasing rate around the world. And the follow-on to the Deloitte report, one of the interesting points for me, that 73% of financial services executives noted that they will be at a competitive disadvantage if the industry doesn't begin adopting blockchain and crypto assets. And adopting means many different things, but at a minimum, having someone focused on innovation, really moving down the road. And the other thing I would add to that is all of your vendor providers right now, almost all that I can, in my experience, I've worked with, are deep down the road of understanding blockchain and digital assets and how they impact their clients in the banking industry. I would argue if they're not, you should ask them why they're not. Other surveys pointed out some interesting data that really relates to what I'll call the overall population, and we're seeing this play out around the world. But in the US, 17% of United States consumers own Bitcoin or some other form of cryptocurrency. That's over 46 million people. And that's growing, and you'll see some of the data in a moment. And among the consumers who already hold crypto, 60% of them surveyed, and I believe it was the Deloitte report, said that they definitely would use their bank, their existing bank, if it offered them the opportunity to invest or hold cryptocurrencies. That really says a lot about the banking industry, because the truth of the matter is, for many, particularly at the retail level, banks are trusted providers that in many instances have been in their family for generations. But it's interesting when you look at the other side of the coin. That same, this was a different survey in early 2021. It was a survey of senior bank and credit union executives. I do have the link somewhere, I'm happy to share it. Found that 8 in 10 financial institutions have no interest in offering cryptocurrency investing services to their customers. So that dichotomy between what clients are demanding over time and hopefully this changing perspective from senior bank executives about what they will consider offering really needs to align much more closely. And the reason I argue that is that there is no shortage of innovators in this space that are willing to step into that breach. And I believe this is an opportunity for bankers to participate in evolving the banking market and offering value-added services because of things like blockchain and crypto assets. This is also a generational conversation as well. Consumers and businesses much more focused on crypto. That number I mentioned earlier about how many million Americans are engaged in crypto, investments in crypto among Americans is increasing pretty quickly. As a matter of fact, 48% of the investors in crypto that have been involved in crypto got involved in the first 6 months of this year. And also that generational shift, younger consumers, I'm losing track now between Gen X, Gen Y, Gen Z, and I think it's Alpha now. They're much more comfortable with engaging with different disruptors and having banking and other financial services through apps and through other capabilities that these innovators are putting forward. 37% of investors in the 18 to 44 bracket who have not yet bought digital currencies are very or somewhat interested. I've seen other reports that point to statistics over 50%. And again, because it's a generational conversation, that compares to just 19% of those over 60 years old. Younger consumers are much more comfortable with the difference. They're much more comfortable with banking a different way and engaging in financial markets a different way. And they're much more comfortable to be using crypto to do it. They're much more comfortable to be paid in crypto as well. And payments did a wonderful survey as well. 93% of financial institutions surveyed believe that their business clients would use digital currencies. And I think this is important, both for investments and transactions. There's long been this perspective that crypto is strictly for speculation. And in many regards, that's true. But both for investments from a long-term perspective and transactions on a business-to-business basis. I think that's an important fact, and I think it's an important fact for the banking industry to consider. So let's talk about that, the availability of banking services, what we mean by banking services. And I'm sure all of you in the banking space and regulatory colleagues in this space have seen this kind of idea of what banking services are and how they're evolving. Coinbase, for example, recently announced that they're going to let US users deposit any percentage of a paycheck directly into their accounts, either in dollars or immediately transferred into crypto assets with no fees. Other crypto asset platforms, and I should be careful here when I say they're offering quote unquote high yield savings accounts with interest rates that outpace traditional savings. To be clear, those aren't specifically savings accounts. It's more like what we call staking in the crypto space, where you can essentially quote unquote deposit with a platform a certain amount of a crypto and you get interests that's paid back in that crypto. The fascinating part about that is it is many multiples in many instances of what can be earned in a regular savings account today. And again, when you give that thought to that generational challenge, they immediately want to go to higher yield. And that's something that needs to be offered to them. Indeed, some of these platforms are beginning to offer secured loans. And you've seen in the public news, I believe several state regulators have kind of looked at some of the providers in this space. And there's clearly some regulatory challenges there, but certainly this industry is evolving to offer loans based on blockchain and crypto asset technology. And this is especially appealing for unbanked and what we call low credit consumers. I think the last data that I had seen is that in the United States, something like 65 million Americans are either unbanked or underbanked. And innovators are in the space, pardon me, are beginning to look at the opportunity to bring banking and economic services to them. And of course, regulators and legislators, there are clear concerns about stability and clear concerns about consumer protections, which full disclosure, my organization fully agrees with. We've often submitted public comment about why it's important to make all of these capabilities regulatorily compliant without stifling the innovation that these capabilities bring to market. What are these benefits? What are the offerings that we're talking about? And why should, in my opinion, the banking industry pay attention to them? Well, from a payments perspective, we're clearly talking about the prospect of billions of dollars potentially in new deposits in different types of assets. And the recognition that the future of payments is digital. Tokenization, and I briefly mentioned non-fungible tokens. We can do an entire seminar on tokenization. Tokenization using blockchain of USD deposits can modernize the B2B payments world. And I was unaware of some of the data here as we did some of the research. And still a small fraction of something on the order of $23 trillion in B2B payments in the US annually are digital. I would have thought it was far more in the 21st century. Even more revealing to me was the fact that 42% of B2B transactions are still made by check. Let me contrast that with some colleagues I know in different industries that are leveraging blockchain. I don't think half of them know what a check is. They literally don't need to receive a check nor wait for some of the challenges, things like check clearing, for example. And tokenization removes those limitations. It removes the limitations of kind of antiquated payment rails. I know they've worked for decades, but things like cutoff times and overnight or multi-day batch processing, transaction size restrictions, they introduce in markets what we call friction. And friction ultimately costs money. If we can release that friction and get rid of that friction to release that value, that's a benefit to users at the retail and institutional level. That's a benefit to the banking industry in my mind as a whole. Pardon me, going down this payments rails conversation, cryptocurrencies, the related rails, they're not going to displace ACH or Fedwire. I've often had this conversation with colleagues, and I've had some colleagues in banking who tell me that I'm also in accounting and law, that I'm trying to make their jobs go away. That's not true at all. I actually truly believe that traditional rails and digital rails will, by necessity, interoperate. They have to, given the world that we operate in. There's no easy onboarding for some of the capabilities that we're talking about. And why would traditional rails not want to be part of the opportunity here? Blockchain-based systems are giving business customers the ability also to make their customers stickier. And I would argue banks have the same opportunity, embedding B2B and crypto blockchain capabilities into their own systems, making payments even more direct. That really adds to the net worth or value that clients see in different service providers, including banks. Things like clearance and settlement, and I could be wrong, I have to double check this data, came from a wonderful report by CB Insights. Again, if you don't have the opportunity, please make some time to look at some of their public reports, really amazing work. The average bank transfer takes something under the order of 3 days to settle, depending on the implementation, public or private blockchain. But blockchain serving as that decentralized ledger of transactions, where transactions don't need clearing and settlement, they settle directly, and where the record of transactions is more accurate and affirmed than existing platforms, really is a clear benefit in the world of clearing and settlement. It also aids in cross-border transactions, which allow for, certainly can happen in a shorter period of time and costs billions of dollars. As a matter of fact, I had the opportunity to share with Gary and Cheryl and Amy. There was a report, I believe it came out yesterday or today, hopefully you all get it, that really talks about central bank digital currencies, which I'll be talking about, that could save over $100 billion a year in cross-border transactions, fees, and kind of friction that are in the system. Lending, we're beginning to see more and more blockchain-enabled lending, which really is a more secure way of offering personal loans to a larger group of customers. And blockchain, again, making that loan process cheaper, more efficient, more secure. We're even beginning to see in many implementations right now, this idea of peer-to-peer loans that are faster and we're secure, a more secure loan process in general. And we do realize the challenges there. When you get into the space of lending, there are regulatory and legislative challenges that are important and really need to be followed. So we're working with a lot of colleagues in the space to help them understand that. Indeed, recently the Federal Trade Commission estimated that something like 20% of Americans have a material error, for example, in a credit score based on lending. What happens if we can use blockchain technology to minimize those material errors? How much economic value does that open up for the population? And then again, I mentioned this a bit earlier, the potential to borrow money against blockchain-based assets like Bitcoin or NFTs. Important considerations as we look at, again, that evolution. What do we mean by lending and who participates in that space? Customer KYC and fraud prevention, sorry. So many of my colleagues in this space, including in space in financial markets like stock trading, for example, the onboarding of customers, the verifying identity, ensuring that that information is in order, very time consuming, very costly. And as I dug into some of the research, I didn't realize this goes back a little bit. I want to say it's a couple of years old. I have to double check, but US banks spend on the order somewhere between 0.4 and 2.4% in a 2018 report on operating expenses specifically for AML and other compliance like KYC, BSA, for example. And at the time, that was estimated to be within the United States over $500 million a year. That's an astounding amount of money that's often a replication of different efforts. What if blockchain can be used to change that? What if blockchain can be used for know your customer, AML, BSA, FinCEN, KYC requirements, where blockchain, and I believe it was actually a Deloitte report also that estimated it could bring down the costs for the banking sector easily by over $160 million a year. That again unlocks more value for the banking industry. We wouldn't be complete if we didn't talk about fraud prevention and this kind of the cases of rising fraud and cyber attacks. And clearly most banks and indeed most firms in global financial markets and beyond have these centralized ledger systems that store customer information. We all have our information deposited on these systems all over the globe. They are becoming more and more easy to attack. They're certainly becoming a greater focus for hackers around the world to attack. And let's not be fooled. Cybersecurity hackers around the world have an increasing amount of resources to do this. And we can have a very prolonged conversation on state sponsors that really help them with the latest technology target these centralized ledger systems. And our argument is that by decentralizing the storage of potentially your client's information, for example, blockchain tech can prevent hackers from gaining easy access to all of the information, even things like backward social engineering, where they can take pieces of individual information and put together a profile of Ron or Gary or Amy for cybersecurity attack. That begins to become very difficult in a decentralized world. You can imagine blockchain storing customer information on different blocks and preventing attacks on customer information. And give thought to what we talked about a bit earlier, this kind of idea of consortium blockchains. Imagine the consortium is a bank and a regulator and an insurance provider and a forensics firm. When you begin to re-envision what that kind of ecosystem can look like, those benefits really become very clear. So I wanted to talk a little bit, and I know I'm running out of time. Gary's probably chuckling because I'll just keep talking about this stuff. I want to talk about a couple of the biggest innovations in my mind that I think are very, very important. One is central bank digital currencies, which I'll give you a very basic definition, is a digital currency or cryptocurrency issued or proposed to be issued by a central bank. For the most part, these are still in conceptual or trial stages of development. I know many central banks around the world have published papers. I know the Bank for International Settlements has come forward talking about a CBDC as a new form of central bank money that kind of differs from traditional reserves or settlement accounts, and really done significant analysis there. And clearly CBDCs have been inspired by Bitcoin and other blockchain-based cryptocurrencies. The difference is that a CBDC, again, would be issued by a state or at least have the official legal tender status. El Salvador is a good example. I know colleagues in banking and financial services kind of chuckle at that El Salvador has adopted Bitcoin as legal tender. I would offer to my friends and colleagues to keep in mind that El Salvador has had the United States dollar as legal tender for 2 decades. And it's interesting because this may or may not use any sort of distributed ledger. Again, think about the private blockchains we were talking about. It'll probably be difficult for government entities or central banks to fully engage public blockchains. I don't see that happening in my lifetime. But again, if they can use blockchain for the benefits we talked about earlier, that might give them the opportunity to reach individuals. And think back to stimulus payments. Think back to federal government responses to things like COVID. Will blockchain-based capabilities, including CBDCs, make those better? And more than 80% of the banks that we've researched are looking at CBDCs now. Decentralized finance. So I have friends and family who often ask me, what is the cutting edge of crypto assets and blockchain technology? And my answer right now is decentralized finance, this idea of a blockchain-based form of finance that entirely does not run or rely on central financial intermediaries, brokerages or banks or exchanges, but is working to emulate traditional financial instruments using blockchains and crypto assets and smart contracts. Pardon me, and you're beginning to see services, and I alluded to some of them earlier, where users can lend or borrow funds from each other, can trade crypto assets, speculate on price movements, including with things like derivatives, believe it or not, earn interest in, again, savings-like accounts and far more. Really, we're beginning to see a significant amount of time and resource being spent on this, and I know that it is deep concern to regulators and legislators as well, and we understand that and we agree with that. I think there's a challenge around decentralized finance, which is totally anonymous. And right now, there are no platforms that I'm aware of that do KYC AML for decentralized finance. Our presupposition is that there will be over time as this evolves. Decentralized finance uses that kind of layered architecture. They're all built on top of blockchain, the way you can envision applications or our web browsers built on top of the internet. Again, some of them are promoting high interest rates, but they are subject to high risk. I honestly, and again, nothing I mention in this presentation is based on my organization, and certainly is not investment advice, but I've told colleagues I highly recommend you don't engage it, or at least be very prepared that it's high risk. There's obviously, as I mentioned, increasing regulatory scrutiny, but let's keep in mind the current DeFi market, when I put this presentation together last week, was $145 billion. Of what we call locked value. Think about it as global market cap, and it's growing rapidly. And as of this writing, there were over 470 new DeFi marketplaces available. Our belief is that decentralized finance is not going away. I know depending where on the regulatory spectrum some people sit, they'd like to see it go away. But we believe that there are tools and capabilities being built to allow DeFi to protect investors, to protect bankers, and to protect accounts in a way that allows for that peer-to-peer, or more appropriately, peer-to-contract capability, but that lets that industry grow, but again, protects investors and protects bankers and others. I would argue that there'll probably be a little bit of a bumpy road. I think we're looking at regulation by enforcement for the time being, until there's a greater framework of regulation, but again, a big part of the marketplace as well. And then finally, stablecoins. Several reports came out recently, and some of you may have seen the president's working group, which has members, I believe it's of the Fed, of the FDIC, OCC, I could be wrong, and some others, really put it forward a draft or a report on the impact of stablecoins. Cryptocurrencies, stablecoins are cryptocurrencies where the price is calculated or connected, pardon me, to a cryptocurrency or fiat money or commodities. It's really meant to be a bridge between crypto assets and traditional finance. And it really emerged to minimize the volatility of crypto assets. Collateralized stablecoin, pegged to another asset, again, like the US dollar. And interestingly, that DeFi I mentioned, one of the most common ways to get involved in DeFi is to leverage a stablecoin for a variety of reasons, not least of which is you don't want to use a volatile asset on an even more volatile platform. So people are using stablecoins to participate in the DeFi ecosystem. But there are benefits to stablecoins, benefits that might include better anti-money laundering management, better client data protection, better tax compliance. When we talk about the Internal Revenue Service and tax payments and tax enforcement, what if stablecoins and participation in those markets enable potentially real-time tax payments? These are some of the conversations that are beginning to happen in this space. Again, there are the challenges of auditability. Are they truly holding the reserves that they say they're reserving and pegging that particular crypto to? I keep mentioning the increasing government and regulatory scrutiny, which we believe is actually a good thing and an important thing. We always encourage our colleagues in banking and other industries to sit and talk to the regulators. And regulators worry that these could pose risks, not just to crypto asset users, but potentially the global financial system. For anyone who might be from FDIC, I know that the FDIC recently reported they were studying potentially types of deposit insurance for stablecoins. And this article here, U.S. Treasury is saying that the SEC can regulate stablecoins and that there was a report coming. Of course, I put this presentation together and the report came out immediately after that. So hopefully you all get a copy of that report as well. I'm not going to restate this. I realize, Amy, I'm running out of time, but obviously the increasing interest from law enforcement agencies, from tax authorities, and that's true around the world. And organizations like mine and so many others that are really working to evolve this space work closely or try to work closely with regulators to understand the pace of innovation. That pace is rapidly accelerating. Federal and state regulators, member of Congress have expressed concerns about blockchain and crypto. I think we're looking at a much more stringent perspective, particularly from some regulators and some personnel in the new administration. But hopefully, we help to evolve. We work together to help to evolve the world of blockchain and crypto assets. So regulators, again, working to regulate stablecoins. New administration, I just mentioned this earlier. Crypto trading and lending platforms offering returns. And Chairman Gensler at the SEC said this. I, again, think rightly. They are wrong to think that they can avoid regulation. Let me share with you that colleagues in the crypto asset space, no legitimate colleagues in this space or firms that we're aware of want to avoid regulation. They just want to do it right. And they're looking for clarity around what that regulation means for them. So I'm going to skip forward a little bit, Amy. I realize I've got about 60 seconds. Again, adding to this one last thing, the SEC recently approved a crypto stock ETF. They also recently approved a crypto futures ETF. Obviously, the industry is working to put forward a crypto spot ETF, particularly based on Bitcoin, on the belief that there will be billions of dollars that will pile into that. We'll see. I don't think we'll see that this year. And hopefully the SEC and other regulators will consider it, though. So finally, I want to leave off with how to adapt. What does blockchain mean for your business? I would offer up to all of you, and again, such a privilege to be here and have this conversation with you. Blockchain is no longer a buzzword for the banking industry, and I would argue for any industry. It's here, it's part of what we're doing. Crypto assets will be or are part of what we're doing as well. You won't need to be engineers, and I often get this from so many colleagues. Ron, will I need to code to stay a banker, a lawyer, an accountant? The answer is no. So many of the vendor providers and consulting firms that you work with now are already deeply down this road. And as I mentioned earlier, if they're not, you need to ask them why. I would offer up strategically, please assign a thought leader. If you don't have someone dedicated at least some portion of time to understanding what these innovations are, to understanding how they're evolving and changing, I would argue with you, you're already falling behind. Also, canvass your clients. I've often mentioned to colleagues in this space, you do not want to be any provider in any industry that has a customer walk up to you and say, I need help with something in the crypto space, and your answer cannot be, we don't know, or we don't do that. In the 21st century, there are competitors who will easily do that for them. So canvass your clients, ask them what they're looking at. I have a colleague in this space that often says, if you think you don't have a client or a customer, particularly a banker customer, that is not involved in crypto, you're wrong. You probably do. And then finally, bring this internally. Use this as an opportunity to grow your talent. That generational shift we talked about. Consider the impact of your talent and your clients and understand, give them the opportunity to innovate and evolve your business models. I think for bankers and so many other industries, that's critically important as well. Amy, I think I'm going a little fast and I just about ran out of time, but that is the entirety of my presentation. Thank you all for being here. Gary, any questions or any other comments that I might have missed?
Yeah, Ron, we actually do have a few questions, believe it or not. You know, shocker that we have a few questions from this, but one of the questions was, do you have any sort of indication on the number of financial institutions that have partnered with FinTech Custodian to offer services to their customers? And what is the rate of adoption for community banks currently?
So good question. The first part of that question is I want to say, and I just got done, Gary, saying, don't say you don't know, and right away I have to say, I don't quite know. I can share with you across our membership, certainly, the larger providers are either partnered with or building internally those different systems that are blockchain based or experimenting with them. And like so many different industries, Gary, we're starting to see it seep down into industry size. So a lot of mid-market firms across different ecosystems. I've had the privilege of chatting with a lot of community bankers. I do, full disclosure, we have a couple of community bankers that are members of the WSBA that are working with providers in this space to understand crypto and custody and blockchain. I think that number is small, but it's a different conversation, Gary, than you and I had in 2018. That number was 0, I think, in 2018 when you and I were on stage. So it is moving that way.
You know, Ron, I think there's a lot of discussion around, crypto being an asset, right? When you really started talking about it, one of the questions that came is do you consider cryptocurrencies an investment? It takes energy to produce, which we kind of talked about it in previous times, where it does take a lot of energy, right, to do the nodes and everything else. And then it doesn't pay dividends. It costs money to store and trades and it's a volatile patterns, right? Is this a fad or an investment? That's really the question.
So that's a loaded question too, particularly because I've wagered the entirety of my career over the past decade in crypto and blockchain. So I say this sincerely, it is not a fad. I believe that from the perspective of how I'm seeing different markets evolve. It's a harder question to answer when you say, is it an investment? For my 18-year-old niece, who is more than happy to throw some money in Bitcoin and hopefully wake up in 20 years and be rich, sure, I guess it's a speculative investment. I have not put my retirement portfolio in crypto at all. But I think, again, how we talk about investment and what it means to engage that is evolving. My father from a long time ago, the only investment he ever thought about was savings bonds at a bank. We don't have those conversations anymore. And I want to address one thing there as well, Gary, because I think whoever put in the question, it's a great question. When you think about it being energy inefficient and all of these other concerns, keep in mind that the innovation and technology background and work happening there is meant to evolve that. So Bitcoin is evolving, Ethereum is evolving, all of these proof of work systems that everyone says, oh my God, it's destroying the climate, Ron, Bitcoin is terrible. There was a report, I think it was Chainalysis, apparently Bitcoin is 4% of the entire carbon footprint of the global financial industry. So I get the argument, and there's a lot of work happening to make them more efficient, more effective, cheaper. Some of them have fees. The centralized exchanges have fees. The DeFis don't have direct fees. You kind of participate in kind of a maker-taker model. But a lot of work's being done, Gary, to innovate those.
Well, Ron, I think we're out of time. Again, I appreciate you. If you want me to shorten your bio, you know who you have to go through to make that happen, right? So
I'll go
if not, you know who I'm in trouble with if that doesn't happen, right? So
I think I'm in trouble already, Gary, but this was really a privilege. Gary, Amy, Cheryl, thank you so much for everyone who participated. It was really a privilege to speak with you. Here's some of my contact information. Please do reach out if there are additional questions. And Gary, if anyone needs additional information, please let me know. Happy to share it.
Yeah, too, Ron, also, just so that you know, you mentioned that article you shared with us. We have uploaded that to the app, so everybody should be able to pull your presentation down along with the information. Thank you, Ron. Again, we appreciate you very much. Have a great day.
Much appreciated. Thank you, everyone. Yep.